After studying this module, you will be able to learn about the various value-based performance measures, understand shareholder value added and its computation, identify the difference between shareholders' value added and other traditional performance measures, learn SVA with the help of examples, know the market value added, and evaluate the usefulness of economic value added, shareholders' value added, and market value added in decision-making process. Maximizing the shareholders' value has always been the ultimate aim of every company. Investors are very keen in assessing the corporate financial performance that correlate with shareholders' wealth, particularly the market price of a share. Traditional performance measures like return on investment, earnings per share, etc. have been used as most important measures of shareholders' value creation. But in the recent years, value-based measures which measure performance in terms of change in value have received a lot of attention. There are several value-based measures such as cash flow, return on investment, shareholders' value added, economic value added, market value added, and cash value added. The current module discusses EVA, SVA, and MVA. Let us first discuss the concept of economic value added. Economic value added is an after-tax profit that exceeds the cost of capital or required minimum return on capital. It is computed by deducting the cost of capital from the after-tax profit. It is the best measure of the true profitability of an enterprise. Though EVA is relatively new to the financial press, its conceptual foundation is not. The term EVA was recently copyrighted by the consulting firm Stem Stewart and Company. Prominent US corporations such as IBM, Coca-Cola, Procter & Gamble, Johnson & Johnson, Microsoft, General Electric, Eli Lilly, Monsanto, Bosch & Lomb, AT&T, and Indian companies such as Infosys, BPL, HLL, NIIT, TCS, Godrej Soaps, Ranbaxy Laboratories, Central India Limited have adopted EVA. Infosys Technologies is the first Indian company to report its EVA. The EVA framework developed by Stern Stewart and Company is gradually replacing the traditional measures of financial performance on account of its robustness and its immunity from creative accounting. It is an estimate of a firm's economic profit. It measures the value addition to an organization. EVA is the profit earned by the firm less the cost of financing the firm's capital. The idea is that value is created when the return on firm's economic capital employed is greater than the cost of that capital. Traditional performance measures such as net operating profit after tax, earnings per share, return on investment, return on equity, etc., have been criticized due to their inability to incorporate full cost of capital, thereby accounting income is not a consistent predictor of firm value and cannot be used for measuring corporate performance. Operationally defined, EVA is the difference between net operating profits after taxes and capital charge, that is, cost of capital employed or the product of capital employed with the difference between return on capital employed and cost of capital employed. EVA is equal to net operating profits after taxes minus capital charge where capital charge is equal to WACC multiplied by CE, where WACC is weighted average cost of capital and CE stands for capital employed. NOPAT stands for profit after depreciation and taxes but before interest cost, or EVA is equal to capital employed multiplied by return on capital employed minus cost of capital employed. Capital costs include both the cost of debt finance and the cost of equity finance. The cost of these sources of finance is reflected by the return required by the funds provider, be they a lender or shareholder. This capital cost is referred to as weighted average cost of capital and is determined having regard to the relative capital structure of the business. WACC is used in SVA as the minimum hurdle rate of return the firms need to exceed for value to be added. The formula for WACC is WACC is equal to cost of debt multiplied by total debt divided by sum of the total debt and CMVE and the whole multiplied by 1 minus tax plus cost of equity multiplied by CMVE divided by the sum of total debt and CMVE, where CMVE stands for company's share price X total shares outstanding. Let us now move on to the concept of shareholders value added. Shareholder value added is a metric which reflects a company's performance in a way that is meaningful to shareholders. As its most theoretical level, it implies that the primary goal of any company should be to increase the returns to shareholders, not necessarily to create value for the company as a whole. Those seeking ever higher shareholders value added believe that management should make decisions for the company that caters to the shareholders' interests first and foremost. SVA is a value added performance measure of a company's worth to shareholders. The basic calculation is net operating profit after tax minus the cost of capital from the issuance of debt and equity based on the company's weighted average cost of capital, that is, SVA is equal to NOPAT minus cost of capital. SVA represents the economic profits generated by a business above and beyond the minimum return required by all providers of capital. Value is added when the overall net economic cash flow of the business exceeds the economic cost of the capital employed to produce operating profits. Therefore, SVA integrates financial statements of the business, that is, profit and loss account and balance sheet and cash flows, into one meaningful measure. The SVA methodology is a highly flexible approach to assist management in decision-making process. Its applications include performance monitoring, capital budgeting, output pricing, and market value of the entity. Now we would make a comparison with conventional performance measures. Conventional ratio analysis based on accounting data has historically been regarded as more useful to the management of a business rather than to the investor shareholders of the business, whereas accounting measures focus on residual profits after tax equivalents measured against the total asset base. The value-based income statement concentrates on the operating performance of the firm by adjusting net operating revenue by the allocation of a capital charge incorporating the economic operations of the business. As such, SVA takes into consideration one important variable that most traditional accounting measures do not, that is, how much capital is being employed in the business. SVA combines income statement and balance sheet data to determine the excess return available to all capital holders. Additionally, through the use of weighted average cost of capital, SVA implicitly addresses the concepts of risk and shareholders' expectations. The value-based view explicitly recognizes the capital charge associated with the use of capital. The bottom line under this format is, therefore, quite different from that under the traditional view. A positive bottom line signifies a superior performance because it accounts for all costs associated with the enterprise, including that associated with capital. It is important to recognize that SVA is not meant to be used in a vacuum as the sole measure of value. Rather, it is an additional measure which can be used in decision-making process. Let us work out an example on the use of SVA. The first step is the calculation of NOPAT. The first step is determining SVA is to calculate NOPAT from accounting-based data provided. In this example, we have assumed the corporate tax rate to be 36% that will apply to EBIT. From years 1 to 5, earnings before interest and tax are rupees 450, 416, 369, 343, 340 respectively, and income tax equivalents are 162, 150, 133, 124, 122 respectively. Therefore, NOPAT comes out to be 288, 266, 236, 220, 217 from year 1 to 5 respectively. The second step is the calculation of capital employed. From the balance sheet, net operating assets for each year can be found out in the tables such that from the year 1 to 5, net operating assets are 2618, 2828, 3041, 3244 and 3436 respectively. The next step is the calculation of capital charge. Capital charge can be determined by multiplying the total capital employed by WACC such that from year 1 to year 5, capital charge equals 216, 233, 251, 267, 283 respectively. And the fourth and the final step is the calculation of SVA. SVA is calculated as NOPAT minus capital charge such that from year 1 to 5, SVA comes out to be rupees 72, 33, minus 15, minus 47 and minus 66 respectively. The firm has shown positive earnings and positive SVA over the first 2 years of the planning period. However, from the year 3, the negative value for SVA means that shareholder value is being destroyed. Key factors contributing to decline in shareholders' value over the period are the falling revenues and the increase in net operating assets. On the basis of 5 years of data, it appears that new investments are not earning the WACC. Now we will make a comparison with traditional accounting measures. Traditional accounting measures do not recognize that equity capital has an economic cost, that being the opportunity cost incurred by the shareholders when investing in the business, whereas the value-based view explicitly recognizes the capital charge associated with the use of equity capital. Possible results of management not considering the opportunity cost of capital include a misallocation of resources and therefore divergence between business and shareholders' goals. This is highlighted by the table where traditional accounting measures such as return on assets, profitability, liquidity and interest coverage remain positive, although decline over the 5-year period. Given this divergence between traditional accounting results and SVA outcomes, it would appear that the SVA framework has the potential to further assist management in its decision-making process and improve alignment between shareholders and business goals. Let us now move on to discuss the market value added. Stewart in the year 1991 defined MVA as the excess of market value of capital, both debt and equity included, over the book value of capital. If the MVA is positive, the company has created wealth for its shareholders. To determine the market value, equity is taken at the market price on the date of calculation is made, and the debt at the book value. The total investment in the company since day one is then calculated as interest-bearing debt and equity, including retained earnings. Present market value is then compared with total investment. If the former amount is greater than the former, the company has created wealth. While EVA is an accounting-based measure for the corporate performance of 1 year, MVA is market-generated number. MVA is cumulative measure of value created by the management in excess of the capital invested. Shareholder value creation is operationalized as market value added or MVA. MVA is a measure that captures the relative success of firms in maximizing shareholder value through efficient allocation and management of scarce resources. Market value added represents the wealth generated by a company for its shareholders since its inception. It equals the amount by which the market value of the company's stock exceeds the total capital invested in a company, including capital retained in the form of undistributed earnings. Since the main goal of a for-profit organization is to maximize shareholders' wealth, market value added is an important measure to analyze how much value a company has added to the wealth of its shareholders. Higher market value added is better. Market value added is calculated in two flavors. 1. The most common calculation is from the perspective of common shareholders and it equals the excess of market capitalization over total common shareholders' equity. Market value added is equal to market capitalization minus total common shareholders' equity, that is equal to total shares outstanding into current market price minus total common equity. 2. From the perspective of all investors, that is both shareholders and debt holders and not just shareholders. Market value added equals the market value of the company minus sum of the book value of equity and debt. Market value added for all the investors is equal to market value of the company, that is book value of equity plus book value of debt. Market value added for all investors is equal to market value of equity minus total shareholders' equity plus market value of debt minus book value of debt. Let us now understand the relationship between shareholders' value added and market value added. The firm's market value added or MVA is the discounted sum of all future expected economic value added, that is MVA is equal to present value of a series of EVA values. The relationship between EVA and MVA has strong bearing on valuation in the formula. Market value of equity is equal to book value of equity plus present value of all future economic value added. The MVA rate of return concept is similar to that of yield on a bond. When a bond is issued with a yield greater than the current market rate, then the bond will sell at a premium. That is, there is EVA and so the bond will sell at positive MVA. If the yield of a bond is lower than the current market rate, then the bond will sell at a discount. That is, there is negative EVA and so the bond will sell at negative MVA. Since the valuation formula discussed is always equal to discounted cash flows and NPV, then the right estimate of value is always obtained regardless of what the original book value of equity is. Further, we would understand market value added and its characteristics. Value-based management and shareholder value analysis are well-known concepts in the 1980s, but there is now a renewed interest in them and also newer related concepts such as MVA. Market value added is the difference between the company's market and book value of shares. According to Stern Stewart, if the total market value of a company is more than the amount of capital invested in it, the company has managed to create shareholders' value. If the market value is less than capital invested, the company has destroyed shareholder value. Market value added is equal to company's total market value minus capital invested, with the simplifying assumption that market and book value of debt are equal. This is the same as market value added is equal to market value of equity minus book value of equity. Book value of equity refers to all equity equivalent items like reserves, retained earnings and provisions. In other words, in this context, all the items that are not debt, that is interest bearing, non-interest bearing, are classified as equity. Market value added is identical in meaning with the market, that is to book ratio. The difference is only that MVA is an absolute measure and market to book ratio is a relative measure. If MVA is positive, that means that market to book ratio is less than 1. According to Stewart, market value added tells us how much value the company has added or to subtract it from its shareholders' investment. Successful companies add their MVA and thus increase the value of capital invested in the company. Unsuccessful companies decrease the value of the capital originally invested in the company. Whether a company succeeds in creating MVA or not depends on its rate of return. If the company's rate of return exceeds its cost of capital, the company will sell on the stock market with premium compared to the original capital. On the other hand, companies that have rate of return smaller than their cost of capital will sell at a discount compared to the original capital invested in the company. Whether a company has positive or negative MVA depends on the rate of return compared to the cost of capital. Market value added can also be defined in relation to economic value added. EVA measures whether the operating profit is enough compared to the total cost of capital employed. Stewart defines the connection between EVA and MVA as market value added is equal to present value of all future EVAs. By increasing EVA, a company increases its market value added, or in other words, increases the difference between company's value and the amount of capital invested in it. The relationship of MVA with EVA has its implication on valuation. By rearranging the formula, market value of equity can be defined as market value of equity is equal to book value of equity plus present value of all future EVAs. MVA is essentially the difference between the company's current market value as determined by its stock price and its economic book value. For example, in the case of General Electric, which was the top US performer at the end of the year 1994, the total market value of GE's debt and equity at that time was $101 billion. And since the adjusted book value of that capital was only $46 billion, GE's MVA amounted to 55 billion US dollars. MVA is far more revealing figure than a simple rise in market capitalization because the latter fails to consider the money investors put up. For example, if a company increased its market capitalization by rupees 500 crores over 5 years, but at the same time plowed back rupees 600 crores in retained earnings, it actually has destroyed rupees 100 crores of shareholders' wealth. For instance, the MVA of Infosys Technologies Limited for the year ended 31st March 2010, the year 2014 MVA has increased tremendously, and that is reflected in the increase of share price of Infosys Technologies in the stock market. Thus, investors should focus on MVA instead of market capitalization, as market capitalization is a misleading indicator of success. For instance, the year 2014 results of company X and Y, that on the basis of market capitalization, company Y may be perceived to be doing well, and only 9 billion US dollars it is behind X. But MVA shows that it is far behind company X, as it has destroyed shareholders' wealth to the tune of 1700 US billion dollars. Let us summarize what we have learned in this module. Value-based management system has gained popularity in academic literature in last 2 decades. One such innovation in the field of internal and external performance measurement is EVA. Economic value added, or EVA, is an estimate of a firm's economic profit being the value created in excess of the required rate of the company's investors being shareholders and debt holders. EVA is popularized by and registered trademark of the US firm Stern and Stewart and Company. EVA is the profit earned by the firm less the cost of financing the firm's capital. The idea is that value is created when the return on the firm's economic capital employed is greater than the cost of that capital. EVA is the net operating profit after taxes less a capital charge, the latter being the product of the cost of capital and the economic capital. The basic formula is EVA is equal to ROI minus WACC multiplied by capital employed. SVA represents the economic profits generated by the business over and above the minimum return required by all providers of capital and is calculated by using the residual income method. Market value added is the difference between the current market value of a firm and capital contributed by investors. Economic value added, or EVA, is an estimate of a firm's economic profit being the value created in excess of the required rate of the company's investors being shareholders and debt holders both. The firm's market value added, or MVA, is the discounted sum, that is present value, of all future expected economic value added. MVA is equal to present value of a series of EVA values.